Welcome back to Investing Talk Podcast. Today, we're taking a look at a company that gets a lot of attention, maybe more than most. AMC Entertainment Holdings.
Definitely one people watch closely. Volatile, for sure.
Absolutely. And we know many of you are following it, given its history. Our aim today is to cut through some of that noise, look at the actual data fundamentals, financials, technicals, what's coming up, to help you answer that key question. Is now a good time to maybe buy? Before we really get into it, please do hit subscribe if you haven't, like this analysis if you find it helpful, and drop a comment below.
Yeah, we do read those.
We do. Let us know what you think. And hey, if there's another company you want us to look into like this, mention it in the comments. We'll definitely consider it.
So our goal here is pretty straightforward. We're taking the latest financial info, analyst views, all from the material provided, and trying to give you a clear, balanced picture of AMC's situation right now.
Right. Balancing that recovery story against the very real risks.
Exactly. To see where the real opportunity, if any, might be for you.
Okay, let's start with the foundation, the financials. Where do things stand?
Well, looking at the trailing 12 months, so up to Q2 2025, the scale is there. Revenue is significant, $4.92 billion.
That's a big number, a huge operation.
It is. But, and this is the key thing, they're still operating at a net loss, about $363.1 million.
Which works out to an EPS, earnings per share, of negative $0.90. Still in the red. Still
in the red, yes. And seeing a loss that big can, put people off, but context really matters here.
Okay, so what's the context?
The trajectory. That $363 million loss, while large, is actually an 11% improvement compared to the loss they posted the year before in 2023.
11% better. Okay, what does that translate to practically? Does it mean they're cutting costs effectively or?
Both. Likely means management's either finding around $40 million more in cost savings or generating revenue with better margins compared to last year. It shows tangible progress.
Progress on cost control, maybe margin recovery.
Exactly. It signals they're moving, maybe slowly, but moving towards being cash flow positive, which they absolutely need to be given the debt situation we'll get into.
Right. And I guess that progress is why the longer-term forecasts aren't totally bleak.
Precisely. Analyst consensus looking out towards 2028 sees revenue potentially hitting $5.7 billion. That implies about a 5.3% annual growth rate.
And crucially, a return to positive earnings by then.
That's the projection, yes. So the expectation isn't just survival, it's growth back into profitability.
Okay, but that growth depends on them staying competitive, right?
Yeah.
What gives them an edge?
Well, their size is number one. They're still the biggest exhibitor screen-wise in the U.S. and Europe. That scale gives them clout, leverage with studios for getting the big movies.
And they really push the premium experience, don't they? IMAX, those fancy recliner seats, better food.
They have to. That's how they differentiate, justify higher prices, and capture customers willing to spend more. It's about making it an event, not just watching a film. And underpinning that is the loyalty program, AMC Stubs. That provides a base of repeat customers, which is vital when you depend so much on, frankly, whether Hollywood delivers good movies or not.
Right. That smooths out some of the hit or miss nature of the box office.
Helps provide a revenue floor, yeah.
Okay, so operations improving, loyalty programs helping. But let's talk about that elephant in the room you mentioned, the debt.
Yeah, that's been the big shadow hanging over AMC. High long-term debt. It limits what they can do strategically. It's an industry issue, but particularly acute for them.
But they've been making moves there recently, haven't they? Actively trying to manage it down.
They have, and this is really significant. Back in August 2025, they did a financing round that brought in $223 million in new funds. But maybe more importantly, they managed to equitize at least $143 million in debt.
Okay, equitize debt.
Yeah.
Can you break that down simply for us? What does that actually achieve?
Sure. So in basic terms, they swapped a debt something requiring regular cash interest payments for something that can be converted into company stock later on.
Ah, so it takes the immediate pressure off their cash flow.
Exactly. They push that burden potentially into the future, or maybe even eliminate it as a cash drain if it converts to equity. It's a big relief operationally.
And then they did more in October. Something about eliminating notes?
Right. They got rid of about $40 million worth of senior secured exchangeable notes. And the key point the source made was they did this without issuing new shares or spending cash they had on hand.
Pretty efficient.
Very. So if you add it up, since July 2025, they've reduced debt by about $183 million. That's not insignificant.
And the rating agencies noticed.
They did. S&P Global Ratings actually bumped up the rating on their senior secured notes to B after these moves. That's like an external thumbs up saying, okay, the strategy seems to be working, risk is slightly lower.
All right, so that sets the stage for what's coming up soon. The next big thing.
Yep, the Q3 2025 earnings release, that's scheduled for November 5th. Analysts are going to be watching that like hawks.
Looking for proof that the Q2 improvements weren't just a one-off.
Exactly. They want to see continued operational gains, sustained cost discipline, especially after Q2 was a bit of a surprise beat.
And beyond the earnings report itself, there's the holiday season effect, right? The Q4 movies.
Huge factor. Everyone's looking ahead to the Q4 blockbuster slate. The holiday period is usually the strongest for movie theaters. A really strong lineup, maybe a surprise hit, could give them a massive boost heading into year-end.
Okay, so financials improving, debt being managed, near-term catalysts on the horizon. Let's shift to the technicals, the chart picture. Where's the stock price been?
As of late October, October 24th specifically, the price was sitting at $2.73.
And the recent action?
It's been kind of stuck, really, trading in a pretty tight range for the last 3 months. Support seems to be around $2.46, with resistance up near $2.87.
So a sideways channel, maybe drifting slightly down?
Yeah, that's a fair description. Sideways to soft negative.
And relative to those key moving averages?
It's trading just under its 50-day moving average, which is basically right at that $2.87 resistance level. And it's also below the longer-term 200-day average, which is up at $3.04.
So from a pure charting perspective, it needs to convincingly break above, say, $3.04 to signal a real bullish turn.
That would be the technical trigger, yes. A sustained move above the 200-day would get chart watchers more optimistic.
Okay, but here's something interesting, maybe confusing. You said analysts have a hold rating generally.
Correct. The consensus is hold.
Yet their average price target is way up at $3.94. That's what, over 40% higher than the current price.
It's a significant gap, a plus 42.24% upside implied from that $2.73 level.
So what gives? If fundamentals are getting better, debt's being handled, and analysts see 40% plus upside, why hold, and why is the stock stuck below $3? What are they waiting for?
That's the million-dollar question, isn't it? It really suggests the market is in show-me mode. They likely want to see the proof in that November 5th earnings report.
Proof that the recovery is real and sustainable.
I think so. Proof that the shrinking losses can continue even with the ups and downs of movie releases. The market seems hesitant to fully price in the balance sheet improvements until they see confirmation on the earnings front.
Okay. Now, we also had to mention the meme stock factor, right? The retail buzz.
You definitely do. We've seen recent spikes in trading volume, higher than average. That's often a sign of renewed retail interest, that sort of meme momentum kicking back in.
And that acts as its own kind of catalyst?
It can in the near term. It adds buying pressure, creates buzz, increases that daily volatility, which is around 2.89%. But, that kind of momentum isn't necessarily tied to the underlying business fundamentals improving. It's its own phenomenon.
Right. And one more point on sentiment, maybe a caution flag. Insider activity.
Yeah, that's worth noting. Looking at 2025, insiders, executives, board members have generally been net sellers of the stock.
Not a lot of big insider buys recently.
The sources indicate a lack of major purchases. Now, there can be many reasons for selling, but typically, if insiders strongly believed a big sustainable price jump to that $3.94 target was imminent, you might expect to see more buying. It's just another data point to weigh.
Okay, so let's pull this all together. We need to be clear about the risks someone takes on here.
Absolutely. Let's summarize. First, company-specific risk, that high debt. Even with reductions, it's still significant and limits their options if the recovery hits a snag or the movie slate disappoints.
Second, the industry risk. They live and die by the blockbuster pipeline. If Hollywood has a weak year, AMC feels it directly. Content reliance.
And third, the big structural risk, competition from streaming and home entertainment. That's not going away. It's the constant pressure forcing them to keep investing in those premium experiences we talked about.
Got it. Debt, content, streaming. On the flip side, there's always that speculative buzz, right?
Right.
Rumors that could pop the stock.
There is. You hear chatter about potential partnerships, maybe with big streaming companies or tech players doing hybrid events or something.
Or even M&A. Mergers or alliances with other exhibitors.
Exactly. Those kinds of high-impact rumors, if anything concrete ever emerged, could certainly drive short-term excitement, but they are just speculation for now.
Okay, so wrapping it all up, the improving financials, the debt moves, the catalysts, the technicals, the risks. Where does the analysis land overall? What's the thesis?
Synthesizing everything from the source material, the overall rating comes out as bullish with a score of 7 out of 10.
Bullish, 7th and 10. Okay. And the reasoning?
It's really based on that combination of factors: the demonstrated improvement in losses, the clear efforts on cost control and debt management, and the very specific, credible, near-term catalysts, namely that upcoming Q3 earnings report and the potential of the Q4 holiday box office.
So it sounds like there are maybe two ways to think about this for an investor.
Yeah, the analysis suggests two main horizons. Short term, it looks potentially attractive for trading around specific events.
Like playing the Q3 earnings announcement or betting on a strong holiday movie season.
Precisely, playing the catalyst. Long term, however, it's still very much of a high risk, high reward scenario.
Meaning you're betting on the full recovery.
You're betting on the full recovery and the successful strategic evolution of movie theaters in general. If they can really leverage their scale, nail the premium experience, and get back to stable earnings, then maybe that $3.94 analyst target starts to look achievable, maybe even conservative over a multi-year period, but it's a big if.
Okay, that brings us to our final thought for you to chew on. We keep hearing this persistent chatter about AMC exploring deeper ties with streaming services or tech companies. So thinking long term, what kind of strategic move do you think would be most transformative for AMC's value? Would it be merging with another big global theater chain? Or maybe some kind of groundbreaking content deal with a major streamer? And why? Something to consider. Thank you for joining us for this structured look at the source material on AMC. We hope this exploration gives you some valuable perspective for your own investment decisions.